In this video, I'm going to go through the questions and worked solutions for the Investments and Portfolio Management exam. And I'm going to go through how you get the answers to various questions. This primarily will cover topics such as bond pricing, forwards, etc. It will also cover things to do with market efficiency and related topics. So with that in mind, let's leap into these questions and go through how we'd answer them. So our first question here pertains to bond immunization. Now, bond immunization effectively is a situation where you have a liability that you need to immunize against interest rate changes. And the way you do this is you get a portfolio of assets that is supposed to track the changes in the value of those liabilities and the value of the assets to changes in interest rates. So the question is basically, which of the following is true about bond immunization? And we have four overarching options right here that we can choose between. Now, in reality, only option C could be correct. So let's go through why that's the case. So we're basically asked here, which of the following is true about immunization? Our first option is, it requires choosing an asset portfolio that matches an index. This is wrong because it has nothing to do with an index. B is, it's a passive strategy. This is also wrong because bond immunization is not a passive strategy. You have to rebalance your portfolio of assets over time so that your duration of your liabilities matches your duration of your assets again over time. C asks, or says rather, it requires rebalancing as maturities and interest rates change. That is absolutely correct, as I just indicated. The next one is durations of assets and liabilities fall at the same rate. This is not correct because the duration will change over time and it can change at different rates for assets and liabilities. Otherwise, you would not need to rebalance your portfolio. Hence why option C is the correct answer to this question. Our next question pertains to bond duration. Now, duration effectively gets to the idea of how sensitive and responsive are bond prices to changes in the yield to maturity. So we have a few questions about duration. In this question, it basically says, you're considering investing in a perpetuity. Its yield is 7%. You intend to hold it for 2 years. What is the maturity? Now, this question would ideally have a none of the above or not enough information type of answer here. The reason for that is a maturity of a perpetuity is not really a thing that exists. However, say we were to be asked about the duration of the perpetuity, then if we were asked about the duration, then we could answer that using the duration formula. The duration on a perpetuity is 1 plus the yield divided through by the yield. So here, if we were asked about duration, it would be 1.07 divided by 0.07, which is 11.89. But as I indicated, there is not really a maturity for a perpetuity. So hence why we've got this particular type of answer here. The next one pertains to hedging. It says here, you need to hedge a $100 liability that is due in 6 years' time. You have two bonds available. Bond 1 is a zero coupon bond with 4 years maturity. Bond 2 is a perpetuity. Assume the relevant yield is 3%. How much do you invest in bond 1 if you take an immunization strategy? All right, so we have a few steps we need to work through in order to get an answer for this. So in our first step, we need to find the present value of the liability. Here we take $100, divide through by 1.03 to the power of 6, i.e. discount it back 6 years at the relevant yield. This gives us $83.75. The next step is we find the duration for all of our relevant portions here. So the duration for our liability is 6 years. That's when the liability is due. The duration for the assets, we have two assets we need to choose between, a zero coupon bond and a perpetuity. For the zero, it's 4 years. For the perpetuity, it's 1 plus the yield divided through by the yield. So 1.03 divided by 0.03. Here, that's 34.33 years. The next thing we need to do is find the weightings in each of the bonds. So here what we need to do is we need to make sure that the weighted average of the weightings for our two assets is equal to 6. So we take 6 and solve for W here. The reason this is the case is the weightings in the assets have to sum up to 1. So we have W multiplied by 4 plus 1 minus W multiplied by 34.33 has to sum up to 6. We can just solve for W from using this. This will give us 93.4% in our first bond and 6.59% in our second bond. We would then be able to multiply these by the present value of our liability to calculate how much we would put into each of these two bonds. And that would give us our solution here. The next question pertains to duration. It's basically asking here, which of the following has the longest duration? Assume that the required yield on all of the bonds is 6%. This required yield is relevant and important for us because it enables us to get an easy solution to this question. So to see why this is the case, let's first get our duration for our perpetuity. Duration for the perpetuity is 1 plus y over y, so 1.06 divided by 0.06 equals 17.67 years here. Now what you will notice here is 17.67 exceeds the time to maturity, or the maturity date rather, of each of these other bonds. So we've got bonds that have 4 years to maturity and 8 years to maturity, both of which are lower than 17.67. Therefore, tautologically, the perpetuity has the longest duration of any of our options here. Hence why the option, or the answer that is correct, is the perpetuity in this particular case. So what we're now asked about is duration and price change. All right, so suppose bond ABC has a modified duration of 4.9 and a face value of 1,000. Suppose that the market yield increases by 4%. What will the price change be? Well, when we've got the modified duration, our relevant formula is the percentage change in price is equal to minus D star multiplied by the change in the yield. Now what you'll notice here is you are not given the price. Therefore, you would not have enough information to answer this question. So there's simply not enough information based on this type of information here. This is because you haven't really been told the characteristics of the bond, so you can't even price this bond. So there's not enough information right here. So what we can then look at is, well, say for example, we were given a face value. Say hypothetically, this were a par bond where it were trading at $1,000. If that were the scenario, then you could just plug in $1,000 here. So what you can do is you can get your percentage change in the bond. Here that's 19.6%, and it will be a decrement of 19.6%. You can do this whether or not you have the underlying face value, underlying price rather. However, to get the dollar change, you need to multiply this by the price. So say hypothetically we've got a par bond, you would multiply 19.6% by $1,000, and that would give you your decrement in the value or the price of the bond rather. And again, we have another question about duration. So we're basically asked when will the duration of the bond decrease? And we have a few options here. So let's work through why which of these options is correct or incorrect. So say we go with this first one in B. So duration decreases if the term to maturity is higher. That's wrong. Duration increases with the time to maturity. The next potential option is the duration will decrease if the yield to maturity is lower. Now, say the yield to maturity is lower, the duration actually increases. That's because when the yield to maturity goes down, the effect of compounding also goes down. Therefore, the duration is going to increase. So this one is also incorrect. The final one is the coupon rate is lower. So here, the coupon rate being lower, well, that would actually, in fact, increase the duration. So this would not be correct either. So we can basically weed out all of these potential options, which means that none of these options are ultimately correct, i.e., the bond duration will not decrease with any of the options that we have right here. The next one pertains to interest rate sensitivity. So we have two bonds to consider. Bond A is a zero coupon bond. It has 8 years to maturity and a 12% yield to maturity. Your next one is a par value bond, which is B. It has 8 years to maturity and a 6% coupon. Now you're basically being asked about the sensitivity of these bonds to changes in interest rates. Now, in order to assess this, we need to really consider which of these two bonds will have the higher duration. We've got effectively an 8-year zero and an 8-year coupon. The 8-year zero is going to have the higher duration. As a result, the 8-year zero is going to be more sensitive to changes in interest rates. So therefore, what we can look at here is bond A, that's the 8-year zero. So bond A is going to be more price sensitive because it has a higher duration. And that's basically what our answer to this is ultimately going to be. Our next question is pertains to forward rates on bond prices. So you have the following information about forward rates. You must find the purchase price for a 1-year zero coupon bond with a face value of $1,085.70. Now the face value here, that is a little bit idiosyncratic. It's basically just illustrating that hypothetically face values can vary. Alright, so what we have here is we have a set of forward rates, and we need to work out the price of our 1 year zero. Now what you will notice about this is the 1 year zero, when you've got a 1 year zero, the 1 year forward rate is equal to the yield to maturity on 1 year zero coupon bond. So we can just read off 4.7% here. So to get our price, it will be our face value, discounted back 1 year, equals $1,036.96. Now we can also have another question about forward rates. So we have again the following data on forward rates. Now we're asked what is the yield to maturity on a 4-year zero coupon bond that has a face value of $1,027.70. Now in order to get this, we need to get our geometric average of the 4 years of forward rates here. So we can get our geometric average. Notably, however, to get your geometric average, it has to be 1 plus forward 1, multiplied by 1 plus forward 2, multiplied by 1 plus forward 3, multiplied by 1 plus forward 4. Do that multiplication, take it all to the power of 1 over 4. That would give you your yield to maturity on a 4-year zero coupon bond in this case. So if we want our 4-year zero, take that geometric average, 5.49% in this particular case. Now again, we can look at that same type of concept. You have the following information about zero coupon bonds with face values of $1,000. What is the yield to maturity on a 4-year zero coupon bond? To get this, you just take your price for the 4-year and apply that. So in order to get this, we just take our $1,000 and divide it through by 1 plus y to the power of 4. We have to get y such that this will equal $642.09. We can just solve for y here. It's relatively straightforward multiplication and exponentiation in order for us to get our result. This would give us a yield to maturity of 11.71%, given the information that we have to hand right here. Now, in terms of bond prices, we have a question about that here. So we have the following information about forward rates. You're basically asked, what is the purchase price of a 4-year zero coupon bond with a face value of 1,000? Again, we've got a couple of steps here. Our first step is we find the yield to maturity on a 4-year zero coupon bond. To do that, we get the geometric average of our 4-year forwards. So you multiply 1.046 by 1.049 by 1.052 by 1.055. Then take that all to the power of a quarter, and that would give you your geometric average. Subtract off 1, of course, after you've taken it to the power of a quarter. This would give you 5.05%, rounding to 2 decimal places. You can then apply this. So you apply this in order to get your bond pricing here. So you would take your $1,000, divide through by 1.050505, and you take that all to the power of 4, which is not printed out right here on the slides, but this should all be exponentiated to the power of 4, which would ultimately give you $821.15. Now we can next work out the price of a coupon bond. So again, say we have the following information about forward rates in this table, and we're basically being asked, calculate the price at the beginning of the year 1 of an 8.5% annual coupon bond with a face value of $1,000 and 4 years yield to maturity. So we have a few steps we would need to go through. First step again, calculate the yield to maturity. We again get this using our geometric average. So for example here, 1.055 by 1.06 by 1.065 by 1.07. Take that to the power of a quarter and subtract off 1. That would give you a yield to maturity of 6.25%. We can then also use our bond pricing formula. So in order to get our bond pricing formula, we just basically substitute in numbers into our bond pricing equation, which is relatively straightforward because we have all of our inputs here. We have the input that 6.25% yield to maturity. We have an annual coupon bond, so 8.25% paid annually. Face value of $1,000, 4 years yield to maturity. Price is $1,077.57 by just plugging numbers into the pricing equation. Now in our next question, we have a question about the yield curve. It says, which of the following is true about the yield curve? We can go through and eliminate and select some of these. Alright, so our first option is it's part of the Dow Jones. That's wrong because it just has no relationship to the Dow Jones Industrial Average, so that's just kind of a red herring of an answer here. The next one is it can be a forward-looking indicator. That is correct, because our yield curve basically is going to give us an idea of what interest rates are expected to be into the future. The next option is it's the producer price index. Again, wrong. Not really related concepts. Obviously, the yield curve factors in things like inflation. However, it isn't really the producer price index, and it doesn't directly represent that. Similarly, it doesn't reflect the CPI, doesn't reflect the inflation index, albeit inflation is obviously going to factor into things like this. The next one is it plots the yield on bonds of various maturities. That is correct. So yeah, that's what the yield curve literally does. Hence why we've got these two answers are correct here. So F would be our ultimate solution here. 2 or more of these options are correct in this particular scenario. In question 14, we have another question about yield to maturity. So suppose you want to calculate the yield to maturity on a bond. What is the implicit assumption when calculating the yield to maturity on a coupon bond? So our first one is coupons are reinvested at the current yield. This is wrong. The current yield is the coupon over the price. That is not correct. That is not an assumption in bond pricing. The next one is there's no assumption. Well, that is actually incorrect because it turns out an assumption is that coupons are reinvested at the yield to maturity, which is in fact an assumption underlying bond pricing. The next one is coupons are reinvested at the risk-free rate. Nope, not assumed in bond pricing either. And then finally, our assumption could be coupons are reinvested at the coupon rate. Again, that is not correct either. So basically, it's just the coupons are assumed to be reinvested at the yield to maturity. Hence the answer that we have in this particular question. In question 15, it's asking us about a market efficiency related question. It says, suppose you believe the market is semi-strong efficient. Which of the following could be determined using publicly available data? So first one, we have the shape of the yield curve, and that would be correct. We can get that from publicly available data because we just observe bond prices. Like that's something you construct and is tautologically constructed from public information. The next one is future stock pricing movements that generate alpha. That should not really happen in equilibrium. Over the long run, we shouldn't be able to get alpha based on publicly available data if semi-strong efficiency holds. Next one is what the Fed will do at the next meeting with certainty. Again, no, that would rely on private information. So hence, only A is ultimately correct in this particular question. In question 16, we're asked about the Carhart model. And it says, consider the Carhart model. Which of the following is correct, if any? And we have a few options here. So let's first start by looking at what the Carhart model is. The Carhart 4-factor model is basically an asset pricing model that asserts that the expected return on the stock is going to be a function of the market index return, the high minus low factor, the small minus big factor, and the momentum factor. So knowing this, we can start to interpret which of these potential options is correct or incorrect. So the first option is it does not include any technical based factors. That's wrong because momentum is tautologically a technical based factor. The next one is the premia here reflect market irrationality. That again is wrong. These are supposed to be priced factors. They don't per se reflect irrationality per se. They could reflect risk premiums demanded for particular things. The next one is it can benchmark performance against a set of factors. That is correct. That's tautologically what these types of models do. Fourth one is the model includes fewer factors than the Farmer-French model. That is incorrect. The Farmer-French model, in fact, includes 3 factors. The Carhart model includes 4 factors. Then finally, it is not a useful tool for benchmarking. As I indicated, it is in fact used for benchmarking, so hence why that would be incorrect, and hence why we get the answer that we do to this particular question. Now we're next being asked about bond profits. So suppose your CFO asked you to calculate the return on a bond. You bought a 6-year zero coupon bond. At the time of purchase, it had a yield to maturity of 9%. It has a face value of $1,000. You sold it after 6 months. When you saw that the yield to maturity was 8%, what is your annualized return? So let's start going through the steps that are necessary to get our answer here. So our first step is we need to calculate the price of the bond at time 0 when you initially buy it. So here you take your face value, discount it back at the yield to maturity for the relevant number of years. So here the yield to maturity is 9%, discount back $1,000 for 6 years equals $596.27. The second thing you do is you calculate the price of the bond at the end of your holding period. So here you take your $1,000, discount it back at 8%, because remember the yield to maturity has gone to 8%, and take that all to the power of 5.5 years, because we now have 5.5 years until maturity. That gives you $654.89. We then calculate the holding period return, which is just the percentage return you get over your holding period. Here that is 9.83%. And then finally you annualize it, so you just square 1 plus that yield to maturity and subtract off 1 to get your annualized rate of return. Now in this question we're being asked about behavioral finance. It says your friend recently read a post on Reddit about buying into a fictional company called GamTop from a Redditor whose handle is Eat the Bankers. Your friend studied political science at university and works as a barista, where he has spent his time cultivating his luscious beard and a deep-seated hatred for customers who work at the local investment bank. He then buys $10,000 worth of stock on margin. Which of the following characterizes the trade? So we're basically looking at which of these is most likely to characterize this trading situation. So first one is proper risk management skills. Well, this would evidently not be the case because this barista is clearly not a sophisticated investor given his lack of acumen and experience in finance. This would appear to be an incredibly risky trade, buying $10,000 worth of stock on margin without necessarily any real proper analysis. The next one is investing on the efficient frontier. Well, by virtue of the fact that he has bought a stock that is potentially not even well-founded, then that would not necessarily be investment on an efficient frontier. So in this particular case, he would not appear to be investing on the efficient frontier. He appears to be investing because he has heard about it on Reddit rather than anything else. The next one is overconfidence, which would appear to be characterizing this type of trade. This would tautologically rule out rational, well-thought-out decision-making because he is relying on Reddit. Similarly, he is not considering experts because he's considering random people on the internet, and random people that he does not know and cannot evaluate their expertise. As a result, this would reflect a behavioral bias, most likely overconfidence in this particular situation. Now here we're being asked about prices that are above fundamentals. So suppose a share in our fictional company called GamTop is trading well above its fundamental value. Which of the following could be a reason for that to occur momentarily? So we've got a couple of options here. The first one is market manipulation. Well, market manipulation can in fact cause something to trade above its fundamental value. So that could easily be a reason for this to be the case. Short sales constraints could also cause this. So say, for example, the stock were trading above its true value. However, brokers were not enabling you to short sell or required such high margin requirements to short sell that you could not do so feasibly. That could cause the stock price to sit well above its fundamental value for an extended period of time. The next one is a shift in the efficient frontier to the right. Well, that really wouldn't do anything because we're talking about a company sitting above its fundamental value. That would mean that it is above the efficient frontier regardless. So in that case, it would not be an efficient frontier moving that would cause this. And then finally, a shift in the yield curve, that would not cause this either because the yield curve is rather orthogonal to what we're talking about in this case. Hence why only C and D are relevant answers to this particular question. In this particular question, we're asked about limits to arbitrage. It asks which of the following could be a limit to arbitrage, and to select which ones are correct. So optimism is not a limit, that's just a behavioral bias. Dread avoidance, behavioral bias. Conservatism, behavioral bias. Now model risk can be a limit to arbitrage. This pertains to the idea that your models are inherently measured with a degree of inaccuracy. So for example, your models are only estimates of what you expect will happen. It's always possible your model might end up being slightly incorrect. The risk of it being incorrect could potentially limit your ability to arbitrage a potential anomaly away if there's a fear that your model might not be correct. Furthermore, if there's model risk, it might not truly be arbitrage because you still have risk that you're bearing. The next one is implementation costs. This, for example, can be constraints on short sales, could be the cost associated with short sales. It could be the cost associated with margin. Implementation costs can, in fact, limit your ability to erase arbitrage opportunities. So implementation costs can be a factor that is relevant in this case. In this question, you're being asked about strong form efficiency. It asks, assume the market is strong form efficient. Which of the following could provide positive abnormal returns? Now, to be clear here, strong form efficiency assumes that private information is incorporated in stock prices. public information is incorporated in stock prices, and technical information is incorporated into stock prices. So all three levels of information are incorporated into stock prices. This then significantly reduces your ability to make abnormal returns on a trade. As a result, because fundamentals are public information, you won't be able to earn an abnormal return invested on them. Because market characteristics are already incorporated into prices, you would not be able to earn an abnormal return by trading on them. Finally, under strong problem efficiency, insider trading would not even be profitable, because inside information would be incorporated into stock prices, so it would not even give rise to an abnormal return. Hence, none of these potential situations would give rise to an abnormal return or a strong profit in this particular case. Now, this question is effectively asking us about regression tests of capital asset pricing model. So you're told, suppose you are running the following regression. Excess return on the stock is equal to an intercept term plus its beta, or a function of its beta, plus the idiosyncratic volatility multiplied by a parameter, plus the error term. So here, H0, H1, and H2 are your regression parameters. Now it says, assume you believe CAPM is valid. Which of the following would you expect from the coefficients in the model? Now the first option is, H1 is equal to the excess return on the market. That is correct, because under CAPM, the excess return on the stock is equal to the beta by the excess return on the market. So if CAPM holds, you would expect beta to be the excess return on the market. The next option is H2 is equal to 0. Again, you would expect that, because under CAPM, the stock return is not going to depend on the idiosyncratic volatility of that company, because you should not be expected for being compensated for taking on idiosyncratic risk. This therefore tautologically means D and E are incorrect. So if you were to select all that are correct here, it would be options A and C. In this question being asked about yield to maturity. So suppose a bond is trading for $950. It has a face value of $1,000. It pays semi-annual coupons. The coupon rate is 8%. Suppose you buy it when it is issued and it has 6 years until maturity. What is the closest to the yield to maturity? Here one would need to solve this by using effectively the bond pricing formula. So let's see how we might do this in Excel. So here what I have is I've input the things that we know about the bond. So face value is 1,000, price 950, time to maturity 6 years, number of coupons per year 2, and coupon rate is 8%. Now we don't know the yield. We'll need to work this out. So to begin with, I'm just going to put in a dummy value. It doesn't really matter what we put in. Let's put in 12%. We're going to be working this out later anyway. So we've got 12% as our dummy yield. Now what we need to do is, using our dummy yield, which we are going to change, we need to calculate the present value of the coupons, the present value of the face value, and then sum it up to get the value of the bond. Then we're going to set the value of the bond equal to 950 by changing the yield to maturity. So for our coupons, to get that, what we do is it's going to be 8% multiplied by the face value of 1,000 divided by the number of periods being 2. We then multiply it by our annuity factor. So the annuity factor here is going to be 1 minus, then 1 plus, then we take our yield to maturity of 12%, which is our hypothetical yield, divide that through by the number of periods. Then that all needs to the power of the number of periods per year multiplied by the number of years. So that is what is going to be in our numerator. We then divide through by the yield here of 12% over the number of periods per year of 2, and this will give us our present value of our coupons. Now what you will notice here is I clearly have a typo here, and the typo is arising because I did not take the negative of the exponentiation. So now we have the present value of our coupons. Now we next need to get the present value of our face value. That will be 1,000 divided through by the yield to maturity of 12% over the number of periods per year of 2. Take that all to the power of 6, being the number of years, multiplied by 2, being the number of coupons per year. And again, typo here, so let's see what exactly I did wrong in this particular case. What I did wrong here is I should have divided through by 1 plus our yield to maturity. So dividing through by just the yield to maturity is clearly going to give you a wrong number. So that's what we have here. So I then sum it up, and this will give me the present value of the bond. Now here what I'm getting is $832. So what I need to do is, in order to solve for this, I need to use Excel Solver. So say I bring up Excel Solver, what I can end up with is I can set my parameters here. So I need to set the objective function. So my objective here is going to be the total value of the bond, so 832. I am then going to solve this and set this rather to a value of 950. Now I do this by changing this formula, or changing the cell rather, being the yield. And then I'll click OK, and then I'll click Solve rather, and Solver will give me a solution. I'll click OK, and Solver gives me a solution here, being the yield is 9.1%. So that's how I'd go about getting the yield to maturity in Excel for this particular answer. So the answer to our question is going to be 9.1% in this particular case. Now here we're being asked about forward rates. So it says here, you want to determine the forward rate that prevails at year 3 into year 4. You know that the yield to maturity for 3 years is 4%, and the yield to maturity of the 4-year is 7%, and we need to get our forward rate. Well, it turns out there's a relatively straightforward formula that enables us to do this. We know that 1 plus the yield for 4 years to the power of 4 is equal to 1 plus the 3-year yield to the power of 3 multiplied by 1 plus the forward rate. Rearrange this equation and solve for the forward rate, and this would give you 15.53%. We're next being asked about the current yield. So it says, you see that the bond is trading for $875. It has a face value of $1,000. It pays, in this particular case, annual coupons of 5.5%. I'll rephrase that. It pays semi-annual coupons at an annual rate of 5.5% once we get that right. Now, suppose you buy it right when it is issued and it has 4 years until maturity. You also observe the risk-free rate is 2%. What is the closest to the current yield? So what you need to do is work out the current yield. Now, the current yield formula is simply the coupon over the price. So you don't really need to do that much working even. You have the coupon per year, $55. You've got the price given to you, $875. So just do that division, give you 6.286%. So the answer to this is actually significantly less complicated than it might initially appear. Now in this question you're asked about callable bonds. You're basically being asked which of the following is true about callable bonds. So the first one is, they always trade at a premium to straight bonds. That's wrong. So a callable bond is basically a bond where the issuer has the right to be able to buy that back from you. They would always do this, or not always, but they're more likely to do this if interest rates are low, and then they can reissue the debt at a low interest rate. So therefore, your bond is going to trade at a discount. The next one is, the extent of the discount decreases in magnitude as interest rates decrease. That in fact is wrong. The reason for that is interest rates decrease, the bond is more likely to be called. As such, it is going to have that magnitude of the discount actually increase as yields decrease. So therefore B is wrong. E is they always trade at a discount to straight bonds. That's right, as I just said. The next one is F. Callable bonds give people the right, but not the obligation to buy the firm's stock. Totally wrong, not even relevant here. The final one is callable bonds premium over straight bonds, blah, blah, blah. Well, they don't trade at a premium, so that's wrong. So therefore, only E is the correct answer to this question. In question 7, it asks about default risk. It says, which of the following might a lender use to protect itself against default risk and the repercussions thereof? Well, let's go through each of these. Now, as you can see, I've highlighted 2 of these are correct, so that would be what you would select here, but let's see why. So the first one is call options on the company's stock. That's wrong. Call options don't protect you from default risk, not relevant. Covenants would protect you from default risk. A covenant might be, for example, you require the firm's earnings to be above a particular threshold. Or a covenant might be you restrict dividends being issued, or something along those lines. So that could be right. So therefore, tautologically, at least one of the options is right. And we know tautologically that it can't be all of them because one of them is already wrong. Credit ratings don't protect you against default. Credit ratings are just a measure of default risk. Now, credit default swaps also can protect you against default risk. They are effectively, think of them as being kind of like insurance against default. You effectively get a payout if there's a default. So hence, C and D can protect you against default. Therefore, you'd be selecting 2 of the options here are correct. In this question, you're being asked about yield curves and the expectations hypothesis. It says, assume that the expectations hypothesis holds. Suppose that you observe that there is a normal yield curve. What does this imply? Well, the expectations hypothesis tells you that under the expectations hypothesis, the forward rate is equal to the expected short rate. There is no liquidity premium under the expectations hypothesis. So this enables us to rule in and rule out some of the options. So the first one is it's not possible to make inferences about interest rates from the yield curve. That is tautologically incorrect. That simply is not true. you can make inferences about interest rates from the yield curve, so A is just wrong. Next one is, interest rates are expected to decrease into the future. That is also wrong. A normal yield curve will look something like what I've just drawn in here, i.e. interest rates go up as the time to maturity goes up. And therefore, this is simply not correct either, for C. There is, however, the idea that interest rates are expected to increase, which is absolutely correct. And you can think about this in terms of the forward rate formula. So under this forward rate formula, you can see that interest rates are expected to go up as you go through the time to maturity. Next one is interest rates are expected to remain stable. That's wrong because the yield curve is increasing. I just explained that we can infer that interest rates are likely to increase. Next one is investors demand a liquidity premium. That is wrong because under the expectations hypothesis, investors are not demanding a liquidity premium. Then our final option is interest rates will rise and then decline. Nope, that's wrong. I already mentioned interest rates are expected to increase. Hence why our answer here is D. Now in this question, you're being asked about bond prices and relevant risks. It says, suppose you have a 6-year investment horizon, but you purchased a 10-year coupon-bearing bond with a 3.5% coupon. What type of risk, if any, are you exposed to? All right, so the first option is price risk only. Well, we do know we're exposed to price risk because at the end of the 6 years, or that 6-year time period rather, we will need to sell our bond. So we are exposed to price risk. The next option is reinvestment risk. That is correct because we need to reinvest our coupons throughout the life of the bond. So we are exposed to reinvestment risk. So both of these are correct answers. So we know price risk and reinvestment risk will hold and be relevant risks here. The next option is immunization risk. Well, immunization risk is not the relevant risk for this particular situation. That's because we are not immunizing against anything. Immunization has not come up at all in this question. Therefore, immunization risk simply isn't relevant to the scenario that you have been given. And then finally, it says no risk because government bonds are risk-free. Well, that tautologically is not the right way to think about this. Basically, you have a bond that at some point you're going to need to sell, and you're going to receive coupons that you need to reinvest. So as an investor in fixed income instruments, those are the types of risks you are going to bear in this type of scenario. Now in question 30, which is our final question here, it says, you are considering investing in a bond. Consider two bonds, A and B. Both bonds presently are selling at their par value of $1,000. Each bond pays interest of $50 annually. Bond A will mature in 8 years, whereas bond B will mature in 4 years. The yield to maturities on the bonds change from 8% to 9%. Which of the following holds? Well, basically what we're being asked here is what happens when the yield to maturity increases and how are different bonds differently sensitive to changes in that yield. Now, we know the yield to maturity has gone from 8% to 9%. Tautologically, therefore, we know that the bonds are going to decrease in price. So we can automatically rule out a good number of our options here. So we know that the impact is knowable, so we can rule that option out. Now, the next one is the bonds increase in price by the same amount. Now, clearly the bonds do not increase in price. This is wrong. The next one is both bonds increase in price, but one will increase more, and we have A and B as our two alternatives here. Both of these are wrong because the bonds decrease in price. So we can automatically rule out quite a number of our options here. And if one really doesn't know what will happen here, you could always guess. But we can work through which of these is ultimately correct. Now, because we've got two bonds that have different durations, we can in fact determine that one of these bonds will have a greater price sensitivity. So here, what we have is bond B matures in 4 years, bond A matures in 8 years. Therefore, bond A, because everything else is constant about these bonds, bond A has a higher duration and is more sensitive to changes in interest rates. So we know that bond A is going to suffer a greater decrease in magnitude, a greater magnitude of decrease than bond B, because bond A has a greater duration. Therefore, both bonds decrease in price, but A is going to decrease by more. Therefore, F is tautologically wrong, and H is therefore tautologically wrong because of what we've just talked about. So that's how we'd go about approaching bond risk. So I hope overall this has given you some insight into how to answer the questions for this particular exam and the approach to taking answers when you've got questions about bonds and the like. So I very much hope that this will help you with your studying going forward.